Okay, well, if you can see it, then we're in good shape. Let me just get this done here. Okay, so initially this was advertised as a three-part series, but frankly, as I got into it and started putting it together, I felt that we could compact it all down to one presentation so that you didn't have to put up with me after today. So this is basically the entire three-part series in one day, but we're going to make it as quick and painless as possible. So basically, I'm calling this Investing 101. So let's get started here.
If I had $1 million,
if I had $1 million,
I'd buy you a house.
well, I would buy you a house.
And if I had $1 million,
If I had $1 million,
buy you furniture for your house.
maybe an ice Chesterfield or an ottoman.
If I had $1 million,
If I had $1 million,
well, I'd buy you a K car.
a nice reliant automobile.
If I had $1 million,
I'd buy your love.
So yeah, so if you have $1 million, you can buy lots of investment love. There's lots of investment advisors out there who would love to see you and work with you. But if you don't have $1 million, it's getting to be very difficult to find investment advisors. And so this webinar today is focused on people who probably don't have enough money to be able to afford a private investment advisor and are looking for alternatives other than, frankly, their bank branches, which is about all that's left to them, other than what I'm going to show you today. I want to acknowledge Linda and Aaron of NAFR Ottawa Branch, Frank Schilder, who's our Zoom master behind the scenes, who makes sure that everything works technically. Dave Gass, one of our members who puts together the videos for me. And Diane is acting as our master of ceremonies today. I also want to remind you of the disclaimer that nothing in this presentation is advice, even if it sounds like advice. Trust me, it's not advice or recommendation and is for information only. I want to highlight the fact that particularly today, all investing involves risk, and participants, readers should conduct their own due diligence before making any investment decision. So what is Michael's investment strategy? You know, I've been doing these webinars and seminars now for, I think, almost 4 years. And I've kind of distilled it down to 3 relatively simple principles. One, you got to minimize the fees that you pay. And I'm going to show you why that's so important. People think paying a couple of % fees in a mutual fund doesn't amount to much, but over a 10 or 20 year period, those fees can amount to a huge difference in what you keep in your account. The other thing I want to emphasize is minimizing taxes legally, but a bit of an understanding of how the Canadian tax system works. And thank goodness in the most recent budget, nothing changed. Knowing how the tax system works can mean a lot more money again in your pocket. And finally, the most important thing, and really today it is terribly important, is diversification. You've got to diversify your investments, both in terms of the countries that they're from and the types of investments you have, to diversify risk. Because as I'm going to show you, I think we're at a very risky time. So going to start with a poll question here, and you can see the poll up in front of you, so I'll ask you to read it and vote. Canadian bank branches sell only mutual funds because mutual funds have the lowest fees. Mutual funds outperform the stock and bond markets. They're only licensed to sell mutual funds. Please vote now. Okay, I think everyone has voted who's going to. And you're obviously a very astute group because 94% of those who voted said the reason why they sell only mutual funds is because that's the only thing they're licensed to sell. And you are absolutely right, with the exception of GICs. GICs and mutual funds. Mutual funds have the lowest fees. No, I'm going to show you that that is not the case. And mutual funds outperform the stock and bond markets. And again, I'm going to show you that in about 88% of the time, they do not. But the main reason, if you go to your bank branch and ask for investment advice, you get mutual funds because that's the only thing they can sell you. So here's what I call the broken promise of actively managed mutual funds. And this chart shows you the percent of mutual funds who have beaten the indexes. So when we say Canadian equity, we're talking about the TSX 250. When we say US equity, we're talking about the Standard & Poor's 500 or another index. So these are actively managed funds where you got people with brains picking the stocks and saying, you should invest with us because we can beat the index. Otherwise, why would you bother? So look at this. For Canadian equity, in other words, Canadian stocks, over 10 years, 16% of mutual funds beat the index. For Canadian dividend stocks, 9%. For US stocks, 5%. International, a little better. The simple average, just averaging these things together, is about 12% of actively managed mutual funds beat the indexes over a 10-year period. So that means that your chance of picking a winner is 1 in 8. Better odds, I guess, than the lottery, but not much better. And if you want more information on this, the source of this is a report called SPIVA, which stands for Standard & Poor's Index versus Active. This is to the end of 2020, and you can look it up yourself and see this information. But the basic bottom line is that the vast majority of mutual funds continue to underperform the indexes. So why do they underperform the indexes? Well, it's basically fees. Remember, I said that there were 3 key principles to successful investing: fees, taxes, diversification. Well, this is fees. So the typical managed mutual fund in Canada has what's called a management expense ratio. I love that term, managed expense ratio. It's fees, it's what they charge you. And they charge you 2.2% or more per year on average, whether they make any money for you or not. They get their 2.2% before you get a dime. Compare that to the typical index exchange traded fund. I'm going to explain exchange traded funds in a minute. The typical fee there is 0.05. That's 5/100ths of 1%. And then something that has become very popular that I'm going to talk about today is the all-in-one ETF, which basically does everything for you with one buy. And their fees typically are around 0.25. So roughly 1/8 the cost of a managed mutual fund. And basically, the managed mutual funds have a very difficult time of overcoming this difference between their 2.2% fee and a typical index ETF fee. So that's the F in fees, taxes, diversification. So exchange traded funds, ETFs, usually have the lowest fees. So what is an ETF? There's still some people out there who aren't comfortable with it, but it's basically a mutual fund, but it's bought and sold like a stock. And as a result, you can buy it with very low fees. If you have a discount brokerage, online brokerage, the fee is $9.95, or in some cases, $5, and in some cases, $0 to buy. As I said, they're basically the same as a mutual fund, but they tend to be, or they used to tend to be, primarily index trackers, not managed. More and more have come out now to be managed ETFs because the financial services industry is always looking for ways to make money and ruin a good idea. There's no advisors to pay unless you buy it through an advisor. The administration is very simple. And as a result of all this, because there's no advertising, there's no marketing, there's no managers to pay, there's no advisors to pay, there's no bank branch people to pay, the management expense ratio, the fees, as I mentioned, are as low as 0.05% per year. And that's a tremendous advantage. So, as I mentioned, ETFs started off being primarily index tracking, exchange traded funds. What's an index tracker? It's basically just a fund that buys everything that's in an index. What's an index? Well, the TSX 250 is the 250 largest companies in Canada that are listed on the Toronto Stock Exchange. The S&P 500 you may have heard of. It's 500 of the biggest companies in the United States. The Dow Jones, I'm sure you've heard of. They're usually referring to the Dow Jones Industrials, which are 30 companies selected by a committee to represent the industrial economy of the United States. There's indexes for everything. So there's indexes for bonds, there's indexes for emerging markets, there's indexes for small cap stocks. Indexes of everything are available today. And again, as I mentioned, the fees tend to be quite low, although the more specialized index trackers can charge higher fees, sometimes up to even 0.5%. So that's fees. The other thing I wanted to talk a little bit about is the effective Ontario tax rates in 2021. And I want to point out to you two things. Number one, how tax efficient Canadian dividend income can be. And second, the effect of the OAS clawback, the dreaded OAS clawback. So if we look, first of all, at incomes up to about $49,000, this is taxable income per person, individual, up to $49,000. Look at this. If you've got income such as investment income from GICs or withdrawals from a RIF or an RSP, you're paying 24% tax on that, even at $49,000. If you have capital gains, in other words, sell a stock or a mutual fund or an ETF at a profit, your effective tax rate's half of that, because only half of the capital gain is included in your taxes. But look at this. If you've got Canadian dividend income from companies like the banks, the big telcos, pipelines, anything that's a Canadian dividend, your effective tax rate at $49,000 is actually minus 1%. In other words, you pay no tax on that money. So organizing yourself so that you have a certain amount of Canadian dividend income in a taxable account can be extremely beneficial. Even up to $79,000, the tax rate on dividends is only 6%. But look what happens as soon as you get above 79,000. 79,505 is the dreaded barrier that you jump over for the OAS clawback. And look what happens as soon as you go above 79,505. Your income tax jumps by 15% or so, even more because you actually jump tax brackets. So here you can see that other income, such as GICs, RIF, 46.5% over 79,500. Even dividends jumped to 24%, but that's still a heck of a lot better. So basically what this is telling you is that if you've got money to invest in a taxable account, so not RSP, not RIF, not TFSA, but in a taxable, fully taxable regular account, having a fair bit of that income as Canadian dividends makes a lot of sense from a tax point of view. By the way, once you're over 129,075, your OAS is fully clawed back and your tax rates actually decline again because you're not paying that 15% penalty. So tax is very important when you think about where you're investing your money. So what that means is, obviously, you've got to maximize your tax sheltered accounts. Registered retirement savings plans, obviously, we've probably all been investing in those for years. Tax-free savings accounts have got to be used to your maximum. I think the total contribution at the moment is over $70,000 because it's been $6,000 a year for a few years. And if you don't use it every year, the contribution room adds up. And then if you've got grandkids that you want to help for college, the Registered Education Savings Plan is a great place to invest to help your kids because you get a 20% government top-up of annual contributions, and you can get up to $500 a year free from the government, which is a pretty good deal. And all the increase within this RESP is only taxed in the hands of the student when it is withdrawn. And of course, with tax-free savings accounts, there's no tax on any withdrawal. So here's poll question number 2 I want to get into. The Canadian stock market makes up this percent of the world stock markets. Is it 10%, 5%, or 3%? Please vote. Okay, I think everyone voted. So this is a very astute group that we have online today because 88% of you said 3% of the world stock markets, and you're absolutely correct. Canada is a very small part of the world stock markets, and people tend to make a mistake of investing too much in Canada. Now, there's good reason to invest somewhat in Canada. As I just mentioned, Canadian dividends can be really tax advantaged and a great source of income, particularly for seniors like us. But Canada only makes up 3% of the world. And if you look at the Canadian stock market, we miss a lot of the big growth stories in the world. We don't have many technology companies. We don't have many health companies. Well, that's been shown through this COVID fiasco. So when you're looking at investing, diversifying outside of Canada is an important part of things. Now we'll go to the next poll question. So over the past 20 years, the US Standard & Poor's 500 has outperformed the Canadian TSX by 10%, 50%, or 80%. Please vote now. Okay, I think everyone voted. So I like these poll questions. I hope you enjoy them too, because it gives the participants a chance to get involved in the presentation. The correct answer here is 80%. The US S&P 500 has outperformed the Canadian TSX by 80% over the past 20 years. And this tells you something important, again, about the Canadian stock market. Number one, it reflects the Canadian economy, which frankly has underperformed the US substantially. And second of all, it reflects the fact that, as I said, we lack a lot of these big growth stories in Canada. We do not have for example, the FANG stocks, Facebook, Apple, Amazon, Netflix, Google. We don't have the big pharmaceutical companies. We don't have a lot of the big growth stories. And by investing only in Canada, or too much in Canada, you miss a lot of potential growth. So I mentioned to you earlier, all-in-one ETFs. And for smaller investors, I really believe that these offer a great low-cost solution. And I'm going to explain why. I've talked about this before in a number of webinars, but it's well worthwhile talking about it again. So what's an all-in-one, sometimes called asset allocation ETF? Well, in one buy, you get a wide diversification of both stocks of the world and bonds. You get professional management of, how the assets are allocated. What do they contain? Well, they contain stocks of the world, and depending on the mix, Canada and US bonds. The fee, the MER, ranges between 0.2 and 0.25% per year. Now remember, that compares with most mutual funds, which range around 2.2%. So I've just selected here some Vanguard all-in-one ETFs. And it's not that I'm pushing Vanguard. It's just that Vanguard was the first to launch these things in Canada. And frankly, they have the best graphic to show you. So I just show you three of them here. There's actually 5, but these are the 3 that I think most of you might be interested in. So this one on the left is VCNS, it's the symbol. It's what they call the conservative portfolio. It's 40% stocks and 60% bonds. And you can see down here, each of these all-in-one ETFs are constructed of pieces of these 7 underlying ETFs. So there's US equity, Canadian equity, developed ex-North America. So that means like Europe, Asia, or developed Asia, like Japan. Emerging markets equity, China, other parts of Asia, other parts of the emerging world. Canadian fixed income, meaning Canadian bond. Global ex-US fixed income, so again, global bonds, excluding the US. And then US fixed income. And you can see, and you can look this up for yourself and see how it's split up. But you can see in this one on VCNS that the equity portion here is considerably smaller than the bond portion here. VBAL, which is kind of the classic balanced portfolio, 60% equities and 40% bonds. And then VGROW, the growth portfolio, is about 80% equities and 20% bonds. There's also a portfolio which is 100% equities, which I don't think is right for most of us. And there's another portfolio which is about 80% bonds, which again, I don't think is what we're interested in today. But the important thing to mention is that by buying one of these, which is literally one click of a mouse on a discount brokerage account, you get a balanced portfolio that suits your needs, and it's all managed for you. You don't have to do another thing. There's also something called D-series mutual funds, and these are worth mentioning. D-series stands for discount. They're available only through discount online brokers. They're the same funds as are available through banks or advisors. But because you buy them directly, there are no what are called trailing commissions. You may not be aware of this, but every time you buy a fund through your bank branch, it's paying that bank branch and the guy who sold you the fund about 1% every year. And if you buy these funds through a fee-based advisor where you're already paying a fee, they have another series called F series mutual funds. And they work about the same way, but you're paying, instead of paying the fee to the mutual fund, you're paying it to the advisor. So there are these D series, and they are worth considering compared to the all-in-one ETFs. So for example, Mauer, which is a well-known Canadian company, has a balanced balanced or mutual fund, and the MAR on that is about 0.9. So they tend to be more expensive, 0.9 versus 0.25, and you get more or less the same thing, except these are more actively managed. So let's look at some one-click solution examples, and these are for discount broker accounts. So I've put in a few here. One I hadn't mentioned before is a new one that just came out called VRIF. It's also by Vanguard. And VRIF, what they tried to do is pay out 4% per year. So if you're looking for a balanced fund that's going to give you some income, VRIF is one option. It's too new, unfortunately, to give return numbers. So we've got to wait a year or so and see how it does. But let's compare VBAL, which is the balanced all-in-one ETF, with the Mauer balanced. And one more, there's another good balanced provider called PH&N, Phillips Hager and North. It's now owned by RBC. And you can see the relative split, stocks to bonds. You can see the MER, 0.29, 0.25, 0.92, 0.88. And you can see the total return. So if we look at 1 year, because the problem with the VBAL is that it's only been around for 3 years. So we only have fairly short-term information on it. But you can see it yielded about 10.3, Mauer balanced 10.6, and the PH&N was 14.2. If you look at the 5-year, it's about 8.9 and 10.6. And you can see the yield here, which is just what they distribute every year in terms of dividends. So these are all one-click solutions that give you a balanced approach, good distribution, and relatively low fees. Just to show you what it looks like over 3 years, the VBAL, which is the Vanguard ETF, is the dark green line, and it yielded about 18% increase over 3 years. And the Mauer one was the purple line. It's a little higher at about 21. And I just threw in, for comparison's sake, the Vanguard growth portfolio, which was the 80% stocks. And you can see it did the best of all, but not by a lot. So more risk, a little more return. Discount online brokers. What's a discount online broker? Well, basically all the big banks have them. I use TD Direct. There's also RBC Direct, but all the banks have them. And it's basically an online brokerage firm that allows you to buy and sell stocks, ETFs, mutual funds, GICs. Their fees are much lower. So as I mentioned before, in most cases, each trade is $9.95 or less. Are they secure? Yes, they are secure. They go to great lengths to make sure that their whole systems are highly secure. And there's a number of independent ones, such as Questrade and Qtrade, which have even lower fees than the big bank ones. Questrade, for example, allows you to buy ETFs for no fee, although they do charge you a fee for selling them. And I just put this in to show you what it looks like. This is an online broker trade page. This is from a TD Direct. And just to show you how it works, for those of you not familiar, in this case, I use VBAL, the Vanguard Balanced Portfolio, as an example. You can see up here on this particular day, it shows you the last price it traded at. That particular day, it was down 1 cent. You can see the bid-ask difference. So this is how much people were bidding. This is how much sellers were asking. This is the volume to that point in the day, 93,000 shares. It shows you the day's high-low range, and it shows you the 52-week high-low range. In this case, it just shows you the 3-month chart, what it's done, but you can adjust this. I can't do it here. You can go back as long as there's history on the stock. And it lists here the management expense ratio, the dividend payment date, and how much it's paying. And then finally, down here, the buttons to buy and sell. So you simply click on these buttons, you fill in how many units you want, and away you go. It's really quite simple. On the other hand, if you do use a financial advisor, and there's good reason for many people to use a financial advisor, remember, only use one that's fee-based. In other words, don't use one commission-based. Only use fee-based. Typically, the charges are 1% plus or minus, depending on your portfolio size. If you're paying substantially over 1%, you have to ask questions. I would suggest that you want somebody who is a certified financial planner, a CFP. And I certainly suggest that you only deal with people who act as a fiduciary. In other words, they are somebody who, in writing, is required to act only in your best interest. A fiduciary is almost like a legal responsibility. And unfortunately, in Canada, the vast majority of advisors are not fiduciaries, which means they don't have to act in your best interest. So let's come to today. I saw this quote recently from Larry Berman from, he's on BNN and a number of other things. I thought it was pretty good. He said, "We don't know with certainty what markets will do. We only know with probability." So we can figure out what the odds are that something can happen, but there's no way, nobody knows what markets are going to do. There is a famous quote from Warren Buffett who said, "The only value of market forecasters is to make fortune tellers look good." And this is why. So I know what you're thinking out there. You're thinking, are we in a market bubble? Well, look at this. The average return of the S&P 500 is 9% per year compounded. That's this red line. But there are virtually no years when the return was actually 9%. There's a few. But look over the last few years here, how much we've been above that 9%. And this chart only goes to 2017, but in 2018, we were down here, a bit below. In 2019, we were above substantially. In 2020, we were above. So at some point, there's what's called reversion to the mean. We've got to get back on average to this 9% line. So the odds tell us, the probabilities tell us that if we've had a lot of years up here, we're going to have years down here. It's just arithmetic. Nothing we can do about it. So is this a market bubble that we're in? You know, a lot of people are beginning to think it is. Good example, there's a little company that is a digital coin trading platform. I mean, all you can do is buy and sell digital coins on it. It went public a week or so ago. The valuation on the company is $82 billion. There's a deli in New Jersey, a single little deli in rural New Jersey. They did $35,000 worth of business over the past year and a half. Somehow they got listed in what they call the over-the-counter market. It has a valuation of $80 million today. So there are some things that are a little nuts out there. So let's get down to how you put this together. Basically, the longer your time horizon, the more stocks you can own. If your time frame is less than 5 years, like you need a big chunk of money for a renovation or a car or anything, then you want to be very careful. And if your time horizon is less than 5 years, you want to be about 50% in cash through what is laughingly called a high interest savings account, a HISA, and then maybe 50% in something like VBAL, which is 60-40 stocks bonds. If your time horizon is 5 to 10 years, you can take a little more risk, but at this point, it's still a good idea to keep a big chunk in cash. And if your horizon is 10 plus years, you can take more risk. There's only been about 6% of 10-year periods that the stock market has not been positive. So once you get over 10 years, you can take more risk. So in this case, 20% in a high interest savings account, 80% in something like VBAL or one of those balanced mutual funds. And in addition, a little gold these days may be a good hedge against volatility. So if you want to know more about gold, don't have time to get into it today, but I would suggest you go back to my previous webinar, which is on the NAFR Ottawa website, which tells you everything you ever need to know about gold and gold investing. Oops, sorry, I made one click here. If you want to know more about maximizing investment income, talking about taxes and all, and where to invest for the best tax advantaged income, again, go back to my previous webinar, Maximize After Tax Income, also on the NAFR Ottawa website. And finally, I'd like to sum up with the official song of the stock markets for right now.
It's astounding. Time is fleeting. Madness takes its toll. But listen closely. Not for very much longer. I've got to keep control.
Okay, well, enough of that. That kind of sums up what I'm feeling about markets today. So let me just close with one more Warren Buffett-ism. Be fearful when others are greedy, and greedy when others are fearful. And with that, I will shut this down and we will go back to questions.